Hey guys, so the last intro to derivatives video actually got a very good response. So I'm going to continue to do this, but I'm going to make the videos shorter and easier to digest. So less content, but I will try to upload more frequently. So if there's an area that you're really focusing on and you want to learn more about for your portfolio, for your studying, for whatever, this there'll be more bite-sized segments. Let's put it that way. You can go on YouTube and you can see your analytics, and it's most people on the internet have a very short attention span, so I'll try to keep it short and to the point. So today we're going to cover simple hedging. So yesterday we talked about, or the last video we talked about, how big companies will use derivatives and how derivatives were essentially designed to protect investments of these larger companies so that they can smooth out the returns and focus on their business without worrying about price fluctuations in the market. Now, as an investor, your business is to invest. So we're going to see how you can use derivatives to hedge against simple ideas that you already contain. Again, if you missed the last video, myself, just really quick background, chartered alternative investment analyst and a certificate in derivative market strategies, and about 8 years in the field with hedge funds, hedging, risk management, pricing, that type of thing. So let's just get into it. So first we're going to use a futures risk. And our scenario is going to be that you believe in the management of an energy company that uses natural gas to produce energy. So we're going to focus on two risks. Of course, there's many risks in any investment, but the two risks initially here are going to be you're wrong in your initial hypothesis. So you believe in the management of this company. You don't know anything about the future prices of natural gas or the future prices of energy, and that's not your hypothesis and that's not your focus. Your focus on simply is having this management be a good management of a company, and you believe they will outperform what their margins say and what their books are currently at. So your risks being wrong, and then the other risk, and this is the one we're going to focus on hedging, is natural gas price flux. So in this scenario, what's going to happen is that if natural gas increases in price, their margins are going to increase. Assuming they're not hedging on their side, we're just going to leave that out for now. Their margins are going to increase and their profits are going to decrease. If natural gas prices fall, their margins are going to increase and their price is going to increase. So what we need to do is we need to find a way to take that natural gas price flux out of the equation so we can focus on what we studied, and that was the management. So we're going to buy some natural gas futures versus our stock position. So first let's go in and explain kind of what's going to happen here. So we've got the stock price and we've got the natural gas price. So because they buy natural gas to create energy, if the natural gas price increases, right, they are going to have much tighter margins, right? They're buying the natural gas, they're doing things to it, they're converting it to energy. So their price is going to naturally decrease, again, assuming no hedging on their behalf. But our hope is, and the hope of the analyst in this scenario, is that the stock decrease will be less than the natural gas increase because of what we believe in the management. So what we're going to do is we're going to own the stock, which we did, but we also are going to own the natural gas futures. So what this is going to do is going to create two scenarios. If natural gas increases in price, what's going to happen? We are going to make money on the natural gas position. So we're going to make money here. And then we are also on the stock position going to lose money because the stock position we surmise is going to decrease. So we're going to lose money. Our hope is, if we've hedged correctly and if our synopsis about the management is correct, that the gain on the natural gas future is going to offset the loss on the stock position because the management is adding value above their current margins. Okay? Then the other scenario is just the opposite. So if the natural gas price decreases, the stock price increases. So in this scenario, we are losing money on our hedge. Our hedge is costing us money, but we are hoping that if our synopsis about the management is correct, that the stock price will increase in value more than the price will decrease. So the complicated part, and I won't cover it in depth in this video, is the different ways to hedge. You can hedge by notional value, which means if you own $1,000 worth of the stock, you can get $1,000 worth of natural gas contracts. Not ideal. Delta hedging means you look at the delta of the natural gas future. So how much does the natural gas future change versus how much does the stock change, and you weight accordingly. Beta is another way to do it, and what you do is calculate the beta of the stock versus the natural gas index, which is a multiplier number, and you hedge like that. So there are different kinds of hedging, and if we start getting real deep, if this gets real popular, I'll go over those. But for now, we'll say that that's the synopsis of how you have to do it, and then the numbers you can drill into a little later. So the second way is with options. Now, one thing I'll note right away is that options, there are many, many different ways to hedge. There are lots of different hedging opportunities with options. They're great for it. We're going to cover the most simple example and the best example for someone's IRA, RRSP, 401k, whatever your country's equivalent is. A lot of the other strategies, brokers and regulators, they put very big margin requirements on because in theory they have unlimited risk, whereas this has a very defined risk. So the scenario is that you really like General Electric. You like their long-term dividend, but General Electric, if you want to look at a chart, it doesn't move. You know, it's not a mover. If you look at, I actually have a chart here. If you look at a chart of General Electric, we're talking $27 at the low, and we're talking $29 at the high. So you can see that in this is a year period here, hasn't moved very much. So what you're going to do in the case of General Electric is you're going to look at your risks. And this is kind of a hint to all investors out there, is the first thing you should do is look at your risks and where they're going to come from. So the two risks that you're really going to look at is that the GE long-term dividend is less than its opportunity cost. An opportunity cost is basically saying if I put $1,000 here and it earns me $100 a year, but I miss out on the chance of putting $1,000 somewhere else, and that's going to pay me $150 for the year, then I've missed out on $50 of opportunity cost. So again, you really like GE, you really want to stay in it for the long term. Maybe you inherited it from your grandmom or something like this, and you just want to sit back and collect the dividends. The other risk is a price decrease in General Electric. So one of the best ways to hedge a long-term portfolio like this is to sell call options against a price decrease. So we'll go over quickly and we'll talk about, so call options are the right to buy stock. So right now GE is trading at about $29.50. So if you're looking for the right to buy a stock, we talked about how you could buy the right to buy GE at say 31, and that's going to cost you maybe 50 cents. That's what the option is going to cost with the time value. So if you reverse that and you sell this option, you'll be generating the 50 cents. And you put that out for whatever time frame you would like. So let's look at the couple scenarios here. So say that GE, that's currently trading at $29.50, decreases in value to 29. That was one of the risks we were worried about. Well, 29, even. Essentially, for you, the price hasn't changed because you collected 50 cents on that option. You've generated that income. So that's a way to hedge against price decrease, because what you've done is you've generated that 50 cents. And we're hoping that you do it every 6 months or a year, wherever you find the proper value for you for that option. Price 2, or scenario 2, is no change in GE. So we have GE, and it stays at 29.50. Well, you've just made 50 cents per share by doing nothing. That's income. So that's income above and beyond their dividend. So if they pay a quarterly dividend and you're selling quarterly options, you've increased your dividend as well. The other scenario, let's say GE comes out with a new product and we were selling a $31, we were selling a $31 strike. So say it goes up to $32. Well, what happens here is whoever you sold the option to has the right and will, in this scenario, call the options away from you, which is why it's called the call option. So you have to sell them for 31. So you miss this opportunity cost here, but again, you still made your 50 cents. So in this scenario, you actually lost nothing, but you lost an opportunity cost of 50 cents because the stock got called away from you. So these are the risks of this. Of course, there's a risk of a GE collapse, but we have hedged a very small part of it. In return, we generate an income on that stock. So that's something you have to look at as well. So that's a couple simple ways to hedge and how to use derivatives to hedge very simple positions. There's a lot more to it. You need to look at, the math behind it. But this is just to get you thinking of derivatives and trying to eliminate the negative connotation of derivatives and the fact that they're scary and you hear them talked about in the news and this kind of thing. This is what they were designed for. And in the most case, this is what they'll be used for. It's very simple ways to reduce risk on positions and hopefully, over the long run, increase profits for you. But we need to make sure that they're being used responsibly and being used correctly. So like any investment, know what you're going to do before you get into it. So until I talk to you guys next time, trade safe.